Welcome everyone to the Clip Show. So first off, we've got this free 4-day options challenge that is now live. So you can join this. You're going to get a lesson each day packed with value. I promise you. Go to crushthepremium.com/4-day-challenge, as you can see here, and start your journey to either learning options or to get better at doing this. And this is about selling options, trading options with risk management in mind. Anybody who knows me on X, on Twitter, whatever you're calling it nowadays, they know that my approach always considers risk, because things that people tout like, success percentages and win rates and things like that, meaningless. You could have a 90% success rate on your trades. That other 10% is going to bury all the good work you did before and then double that potentially. So win rates absolutely doesn't matter. This game is about good trades, good setups, and success from that standpoint, but it's at least as much about avoiding the bad situations like we saw last week. If you can do things to avoid that, and we provide that in our Discord trading room, we talk about we teach you the MTI system, the MTI indicator in our system that tells you, listen, it's time to step aside, it's time to be careful, it's time to be cautious, because the volatility environment is telling us something. So we are always assessing and we are accepting what the market tells us. We are not fighting the market. This has nothing to do with fighting the market and being smarter than the market, because that, I can tell you, over 3 decades, that does not work for people. So what have we got going here today? We have got an incredible thing. I don't think anybody could have seen this happening, but we had all this seasonality pull forward for August, September, first part of October, which are very, very difficult months typically for the market. We had a VIX zoom from 1213 all the way to 65, and we've had it pull all the way back to the 16s today. So we are actually right back in this seasonal trend here, where things tend to go up seasonally. They just tend to not do what we saw last week, which was up to 65, which, people are talking about how 65 wasn't a realistic level. It was probably more like a 44, 45. 65 didn't really trade. The VIX is based on bid and ask, things like that. So when markets widen, crazy stuff can happen. Doesn't necessarily mean things traded at those points. Now, some of the VIX ETNs had some trading going on. So things like SVIX and SVXY, things like that, VXX, were trading. So there was definitely opportunity out there. But even up to today, we still have some of our risk barometers a little bit on the cautious side. So there has been this volatility echo, right? It's a bit like after a hurricane or a tornado, people are still rushing out to Home Depot to pick up supplies, even though there may not be another event for a long, long time. But people still have that fresh in their memories. So that always is a big thing. Now, this is something that I posted last week in a couple trading rooms that I was hosting, the Leduc trading room. We've got gamma, short gamma. Basically, you don't need to know a lot about this, except that in a short gamma environment, like on the left side here of the blue, you get a lot more volatility, because dealers, people but they're short options basically. They're short volatility, and that exacerbates moves. On down days, we need to sell. On up days, we need to buy. And the same goes for these ETFs and ETNs and ETPs that need to, in a sense, rebalance every day. Now, and I said, I don't mind this market at all. This is a great market. And once we start moving up into this 53 to 5400 area, I said, listen, this is where things can actually start to snowball in the other direction. We can start to get markets kind of climb that wall of worry. And that can be a very meaningful thing. So all the CTAs that had to sell in here, all these trend following strategies that had to sell because volatility was exploding, if we start to get lower volatility, which we're starting to see, they are going to have to start getting back in. And not only that, but a lot of people got out of markets. We saw equity allocations drop quite sharply. And so a lot of people who got out may have to look at this as kind of an oops moment. Maybe we have to start getting in again as things quiet down. So very interesting dynamic at play here, where time makes a big difference. The more time we spend in a lower volatility environment, the more certain strategies are going to have to regross, re-risk, reallocate to markets. I'm not saying that's what's going to happen. There's certainly an argument for things to start snowballing down again, but I don't see it from an economic standpoint. I said last Monday during the crash, I said there is nothing to worry about. And I showed you guys all sorts of charts last week, all sorts of data. There's nothing big going on that is of concern here. So we can see after big VIX spikes that we tend to get big moves, 1 year, 2 year, 3 year, big moves. Couple of exceptions there, 2021, which was ahead of that terrible 2022 year. And then in the global financial crisis, things kind of dragged on for a little bit. But this is not that kind of situation. There's nothing of serious concern. There is no problem with the plumbing in the financial system. There is no massive bubble, maybe a little bit in the AI space, but these companies are generally making money. I'm a little hesitant in that area, but these are not stocks that are priced out of whack like they were in 2001, 2002. This is a very different situation. And what you have to be careful with is this idea of what you read and what the reality is. So suddenly everyone's talking about recession. Oh, we had this weak job number a couple Fridays ago. It was nothing. It was nothing. I don't think that had anything to do with the big crash. Now, it may have been one tiny piece of the puzzle on top of the carry trade, on top of some other things, concentration in technology and AI and all that finally just gave way. Let's be careful. You look at, for example, this morning, we see soft landing mentioned all over the place in headlines. Everywhere. Soft landing this, soft landing this, soft landing that. The news, the media loves to jump onto the current catchphrase. And right now it's soft landing. Are we going to get that soft landing? It starts to worry everybody. Everybody's reading about it. Have you heard there's a soft landing coming? Have you heard? Oh, I read about it here. I read about it there. Everyone's talking about it. The soft landing must be coming. The fact is there's data here. Companies on earnings calls haven't been talking about recession at all. Nothing. They're not talking about recession at all. They're talking about fantastic S&P profits that are through the roof, all-time highs. Things are, in general, we can see in the bottom right here, operating earnings per share, fantastic. Things are going okay. Now, I'm not saying those things are going to stay that way necessarily, but right now, if you are betting against this economy, you are peeing into the wind, and I think that's been a dangerous thing to do for many, many years now. So if you've got your bear hat on, be very, very careful in this kind of environment. We can see here some interesting data, correlation against the SPY as VIX levels go up. So we can see that things correlate. So we saw that during that crash, we had gold do poorly. We had a number of safe havens do poorly. Bonds were a good place to be. But a lot of other areas just became stocks, just became sources of liquidity. So those kinds of downturns can be liquidity events. They sell gold. They sell things that have been working. We saw Bitcoin go from the high 60s to 50. There are very few places to hide in safety when things become very, very disjointed like that. And so you can see here, VIX above 40, everything starts going in a similar direction. High correlation to the market, right? Another interesting thing here, we want to look out for the potential for inflation to return. We have some indications that it has flattened out, and I don't think the Fed is worried about inflation right now. The narrative has flipped to the economy. The economy. Tomorrow we got a retail sales number coming out. That is going to be more important than today's CPI. CPI wasn't a big deal. The Fed has transitioned from worrying about inflation, and the market is going to do that as well, and it's going to start to worry about every data point that leads us to believe that the market could be slowing, because lowish inflation, rates coming down is okay. That is okay as long as the economy doesn't end up in a hard landing, right? This is a scenario where rates may have to come down because real rates are too high. Interest rates over inflation are a pretty good distance right now, right? That's a pretty good gap. That's called the real rate. So if real rates are too high, we can bring down, I don't think they need to bring down interest rates. I think things are generally fine except for massive public debt. But generally speaking, you can bring down interest rates not because the economy is cratering, as everybody keeps talking about, oh, interest rates coming down, it's the end of the world, because typically that signifies something very, very untoward going on in markets and the economy. That's not necessarily true this time. We may have to bring rates down simply because inflation is somewhat under control, in check, and that may be the reality of it. doesn't necessarily mean things are getting worse. So this is going to be the big question going forward. It's going to be data, data, data. Are we slowing? If we are slowing too much in the economy, yes, that is difficult for stocks. If we are not slowing too much in the economy, then bringing rates down is going to be perfectly fine. You can already see mortgage refinancing starting to jump. People are excited again. They're starting to buy and sell real estate. I think that's interesting. Lower rates are good for a massive, massive part of the economy. Massive part of the economy that drives a lot of employment. So very interesting things to be watching. We're going to be data dependent. Bad news is going to be bad news again. Now, as an explanation for what happened out there in risk markets, this is a good one that I heard about recently. 20-year lows on skew. What is skew? It's the price of puts versus the calls in the S&P 500. And what we had was 20-year lows on 6-month skew, meaning everyone at some point over the last year said, not interested in protection anymore. We do not need protection. Why would fund managers say that? Why would they say we do not need protection anymore? Because it has been a waste of money for a long time. And everybody has this recency bias. They look and they go, I don't know, this has been a waste of money. Maybe we don't need it. Secondly, they think that they can time things. And I think this is the important point. If you think you can time a sell-off, then why have protection in place all the time? You can wait for things to get ugly a little bit, to get concerning, and then jump in and add your protection. That may have been what happened last week. Everyone sort of waited for that moment. It got really ugly. That drove VIX up to sort of the 60s and drove all these vol markets bananas, because suddenly everybody said, uh-oh, I need protection again. And everyone doing one thing at the same time is going to stretch the direction in a pronounced way. So that might have been part of it. We went from don't need protection to suddenly everybody needs protection. And this is the feast or famine type market that we have now, right? I always talk about volatility clustering. Volatility can stay very, very low. It can stay very, very high for some time. In this case, it did not stay high for very long because FOMO took over again. And so that's where it's at, guys. I hope you've enjoyed that. We'll get together again soon. And stay safe out there. Don't forget about our 4-day Crush the Premium options challenge. Try to sign up for that and let me know what you think about it. I think it's really, really cool. And we'll see you guys soon. Bye-bye.